Don't touch it. For one of the most technologically advanced industries on Earth, that's a surprisingly effective maintenance strategy. Every time you withdraw cash, transfer money, pay with your card, or check your account balance, there's a good chance your transaction passes through software written in 1959. Not 1995, not 1985, 1959. One of the wealthiest industries on Earth still depends on technology older than the internet. Not because banks can't afford to replace it, but because replacing it carries a risk they're not willing to take. So today, we're opening the vault behind your bank account. To understand why your bank still depends on software written in 1959, you have to forget technology for a moment. This was never a software decision. It was a financial one. As banks expanded after World War II, they hit a physical limit. Paper ledgers required human tellers to reconcile balances by hand every evening. Mainframes weren't adopted to innovate. They were adopted to survive the sheer volume of paper checks moving through clearinghouses. By the late 1970s, many major commercial banks had embedded their core accounting functions into mainframe software. It ran checking deposits, mortgage amortization schedules, interest calculations, and overnight settlements. Then the 1990s forced a choice. Option 1 was to spend hundreds of millions to tear out the existing core and rewrite decades of embedded business logic from scratch. Option 2 was to build a digital wrapper, leave the original engine running in the basement, and drop sleek visual interfaces over the top of it. They chose the wrapper. From an accounting perspective, it was the correct decision. From an engineering perspective, the bill has been arriving ever since. Every time you open your banking app, you are looking at that decision. Your smartphone isn't talking to a modern cloud engine. It talks to an intermediary that translates your request into instructions for an architecture first deployed during the Eisenhower administration. Over time, institutions stacked successive generations of software on top of that same foundation. Replacing it isn't like updating an app. Decades of mortgage rules, tax regulations, and overdraft logic are compiled into millions of lines of undocumented code. For the largest banks, replacing a core platform can cost well over $1 billion. So corporate leadership makes the same cold calculation. Pay $30 million a year to patch the old engine, rather than risk the entire bank trying to replace it. And to understand what happens when a board decides to break that rule and force a migration, we have to examine what happens when someone ignores the oldest rule in modern banking. In 2018, TSB Bank decided to do what the rest of the industry had spent decades avoiding. They would replace the core. More than 5 million customer accounts were scheduled to move from a legacy platform onto a modern banking system. The migration was planned for a single weekend. On Sunday night, the migration began. By Monday morning, the bank was in operational failure. Millions of customers couldn't access their accounts. Branch employees stared at blank terminals. Some customers were shown confidential account information belonging to complete strangers. The software failed. The public noticed. The board paid the price. The recovery cost hundreds of millions of dollars in compensation, emergency contractors, and remediation. The CEO resigned. The software survived. The management didn't. Inside banking boardrooms around the world, the lesson spread faster than the outage itself. Don't touch the core unless you're prepared to bet the institution on the outcome. Which brings us to the real problem. The problem isn't that the software is old. The problem is that the software stopped being just software decades ago. Every mortgage calculation, every overdraft rule, every tax requirement, every regulatory amendment, every exception discovered after millions of real customer transactions. They weren't stored in filing cabinets. They were embedded into the machine itself. Replacing the platform doesn't simply mean writing new code. It means proving that every one of those decisions still behaves exactly the same under production conditions. Most software becomes obsolete. Banking software became too trusted to remove. That is the paradox. The longer the system operates without failing, the more dangerous replacing it becomes, which leaves one final question. If banks are afraid to replace the foundation, who is still keeping it alive? To keep a 60-year-old machine running, you need more than code. You need context. And that is where a financial decision becomes a human dependency. The software isn't the only thing that's aging, so are the people who understand why it behaves the way it does. The rarest asset inside modern banking isn't the code. It's the institutional memory surrounding it. And with every departure, decades of unwritten context vanish from the building. When something fails inside a 40-year-old core system, There is no manual to consult. There are no online documentation threads. There is only the raw source code and the tribal memory of people who haven't worked full-time in 20 years. To keep the lights on, major banks have been forced into an extraordinary strategy. They bring retired core banking specialists back to support critical system operations and sign them to emergency consulting retainers. In many cases, banks pay 80-year-old programmers hundreds of dollars an hour simply to stand by during overnight batch runs. It is a human life support system for critical global infrastructure. Now, institutions are turning to artificial intelligence to bridge the gap. AI excels at translating syntax. It cannot automatically recover decades of undocumented business decisions embedded in the code. For years, banks worried about losing the software. It turns out the software was never the scarce resource. The code isn't disappearing. The explanations are. The fastest way to stop a bank is to improve it. That sounds backwards, until you watch a core banking migration fail. A core banking failure rarely breaks everything at once. It spreads through a sequence of hidden dependencies. To understand why a failed cutover can trigger a bank-wide outage, you have to look at how modern banking systems communicate with one another. The banking app on your phone, the website in your browser, and the ATM on the street are only the presentation layer. Behind them sits a network of systems making constant requests to the core banking platform. When the new core stops responding correctly, those dependent systems don't simply give up. They retry. As more systems retry failed requests, traffic across the bank's internal network begins to surge. The disruption reaches the payment layer. When payment gateways cannot verify account balances with confidence, they switch into protective modes. Card authorizations begin failing. Transfers are delayed. ATM services become restricted. The payment system doesn't shut down because the software is broken. It shuts itself down because it can no longer guarantee accuracy. Then the human crisis begins. Branch staff, call centers, fraud teams, operations centers, they all depend on the same underlying banking core. As response times deteriorate, internal tools begin freezing alongside customer services. The institution loses visibility at the exact moment customer panic begins accelerating. Finally, the disruption reaches the balance sheet. Banking depends on every debit matching a credit. If ledger synchronization becomes unreliable, regulatory reporting, financial reconciliation, and settlement processes are all placed at risk. By the time regulators become involved, the incident is no longer a software problem. It has become a confidence problem. The software locked itself down to protect the integrity of the data. In doing so, it placed the institution's most valuable asset at risk: public trust. When a migration collapses, one question immediately follows. Why not just hit undo? If the new platform fails, rolling back to the old system sounds like the logical escape route. In core banking, it is almost impossible. Because while the software was failing, the real world didn't stop. During the hours or days the new system was active, thousands of real transactions still occurred. Salary payments were processed. Card transactions were authorized. Direct debits continued moving through the system. The moment you switch back to the legacy mainframe, you are not stepping back in time to a clean restore point. You are attempting to reconcile days of transactions with systems that may no longer agree on the state of every account. This is the recovery paradox. Restoring the old software takes minutes. Reconciling the lost data takes months. Recovery teams are forced into manual forensics, rebuilding account states line by line, transaction by transaction, across millions of accounts. By the time the system is technically stable, the operational damage has already multiplied. Software can be rolled back. Trust can't. Financial infrastructure evolves over decades of incremental trust. Deploying software takes seconds. Rebuilding the institutional confidence destroyed by a single failed cutover takes years. In the end, every investigation arrives at the same question. Why does global finance still depend on software written in 1959? The common answer is momentum. That banks are simply slow, conservative, and afraid of modern technology. The autopsy points somewhere else. This was never just a story about COBOL. COBOL became the foundation. The banking system built on top of it became the dependency. For more than 60 years, banks didn't simply run transactions through that foundation. They layered new regulations, new financial products, new compliance rules, and decades of operational exceptions on top of it. Each change made the system more valuable. Each change also made it harder to replace. Replacing it isn't simply writing modern code. It means reconstructing decades of operational knowledge that was accumulated one production incident at a time. The real risk was never the age of the software. The real risk was believing that decades of proven stability could be recreated on demand. Banks aren't waiting for better technology. They are managing an operational compromise. Because in global finance, running an aging system carries risk. But replacing a system that cannot fail is catastrophic. Here is the final verdict. Modern banking doesn't run on software written in 1959 because the industry stopped innovating. It runs on it because, over decades, that software became the foundation beneath everything that followed. Every mobile app, every online transfer, every contactless payment, every digital feature. They all depend on a core that cannot be allowed to fail. The greatest risk inside modern banking isn't that the software is old. It's that the system became too important to replace. In banking, innovation is optional. Trust isn't. And when the two come into conflict, trust wins.